Hey, I'm Jonathan Wild, and we are going to cover how to record purchases of merchandise. First, let's start easy and cover merchandise purchases without discounts. So let's say we own a retail store and we purchase $2,000 of merchandise for cash to resell to customers. To record this transaction, we debit merchandise inventory for $2,000. We debit inventory because assets are increased with debits. On the credit side, we credit cash for $2,000. We credit cash because assets are decreased with credits. Now let's cover how to account for purchases made on credit with cash discounts. When merchandise is purchased on credit, it means that we are agreeing to pay for the goods at a later date. It's kind of like when we purchase a new pair of shoes with a credit card. We get the shoes right away and pay the credit card off later. In business, when purchasing on credit, the buyer and the seller have to agree to credit terms. So what are credit terms? Well, let me explain with an example. Let's say on November 1st, we purchased $2,000 of merchandise on credit with terms 110 net 45. Net 45 means that the full $2,000 payment is due within the 45-day credit period. 110 means that we can deduct 1% from $2,000 if the payment is made within the 10-day discount period. So, if we pay sometime between November 1st, the purchase date, through November 11th, we take a $20 discount and pay $1,980 cash. This discount was computed as $2,000 multiplied by 1%. Now instead, let's say the discount wasn't that good, or we didn't have the cash during the discount period, or we were out too late the night before and forgot to submit the payment. If we pay after the discount period, but still within the 45-day credit period ending on December 16th, we pay the full $2,000. So now for the moment you've all been waiting for, let's see how these discounts affect accounting for transactions. Let's say we purchased $2,000 of merchandise on credit on November 1st, terms 110 net 45. To record this transaction, we debit merchandise inventory for $2,000 to increase the asset account. And we credit accounts payable for $2,000 to increase the liability account. After this purchase, we can do one of two things: pay within the discount period or after the discount period. If we pay on November 11th, the last day of the discount period, we record this entry by debiting accounts payable for $2,000, crediting merchandise inventory for $20, and crediting cash for $1,980. We debit accounts payable for $2,000 because we have now settled the liability and no longer owe money for the merchandise. Our T account also shows a $0 balance now that we have paid off the merchandise. Now this is where it gets a little tricky. We credit merchandise inventory for $20 because that is the discount we got for paying within 10 days. This was computed as $2,000 multiplied by 1%. The merchandise account is credited for $20 because it reduces the inventory account balance to $1,980, which is what we actually paid for the merchandise. Our T account shows that the $20 credit reduces our balance in inventory to $1,980. Again, that is what we actually paid after receiving the $20 discount. We credit cash for $1,980 because this is the amount of cash paid for the merchandise. This is computed as $2,000 minus the 1% or $20 discount. So that was the entry if we paid within the discount period. If we don't pay within the discount period, we still have to pay within the 45-day credit period. Remember, that was the net 45 in our credit terms. So let's say we pay 45 days later on December 16th. In this case, we would debit accounts payable for $2,000 and credit cash for $2,000. We debit accounts payable for $2,000 because we have now settled the liability and no longer owe money for the merchandise. We credit cash for $2,000 because this is the amount we paid after missing out on the discount.